Hello, everyone. Welcome to the Multifamily Deal Structuring Monday. Our guest for today is Alex Kholodenko. Alex is an active passive investor, syndicator in over 50 deals with over 5,000 units in his real estate portfolio. He has over 10 years of strong experience in real estate investing, including single-family homes, tax deeds, and liens, money lending, and fix and flips. He has spent 20 years in the high-tech software industry in the Bay Area, working as an IT professional. Alex has co-founded Wealthy Mind Investments for his lifelong passion for helping people. Now, his focus is on commercial real estate investments because of the simplicity of being passive investor, scalability, and tax efficiencies. He has created strategic partnerships with experienced multifamily operators that have boots on the ground. The success of these partnerships has resulted in increased cash flow and appreciation for all investors. He believes that busy professionals and investors deserve access to proven wealth strategies in commercial real estate investing so they can enjoy life to the fullest potential. Alex is originally from Ukraine, has lived in Silicon Valley the last 25 years, currently resides in Belmont with his wife and two sons. Here's the interview. Hi, Alex. Welcome to the Multifamily Deal Structuring Monday, where we will discuss all about your first GP or some of your early deals in multifamily. Thank you for joining us in the show.
Thank you for having me, Jeff. I appreciate it.
Yeah, we'll have you here. Tell us about yourself.
Yeah, thank you for the opportunity. Again, my name is Alex Kholodenko, originally from Ukraine. I have immigrated to United States 25 years ago. I currently live in Silicon Valley. I'm a tech busy professional who kind of fall in love over time with real estate and passive investing. And I have been investing in real estate for the last 10 years or so, not 20. My experience is growing day by day, but in the last 10 years specifically, I started with single family homes, like typically what you do, right? You know, the idea of owning a large apartment building and partnering with other people did not enter my mind when I was starting out. So I tried flipping homes. I tried going to live auctions and acquired some of the homes that I flipped together with some business partner of mine. I did money lending in the beginning while lending my funds for flippers as well. And over time, I kind of morphed into a syndicator. First, I started as a passive investor. I love the idea of receiving passive income and found out, there was a different world out there called syndication model, private placements, right? So I was one of those early pioneers that started investing through crowdfunding platforms. And I've had some good, some bad, and some ugly experience over time, but it gave me a good head start where I tested the model with my personal funds. And I did a lot of good on that front, made six-figure income in that. Tested the model, started to actually meet some of the other active syndicators and sponsors, went to a different type of events, got to know them, and over time, I transitioned into more active and passive investors. So I do invest passively in other people's deals as well as help others along the way. And the last year, my business partner and I started a company called Wealthy Mind Investments, because we believe that in order to attract wealth, you have to have a right mindset. You have to feel and think like a wealthy person, right? You cannot attract wealth by just pretending to be wealthy. It all starts with the mind, so you have to picture yourself as being a wealthy person and then obviously take some actions toward it. And since then, over the last year, we have co-sponsored and syndicated more than 5 deals now. We're actually in the middle of a race as we speak on our latest acquisition in Phoenix, and I'd love to, share some of my journey and some details on our maybe one of the first acquisitions that we did.
Okay, awesome. Yeah, that's great. Like I love the context of also on the mindset. Yeah, that's really important.
It is.
Right. Yep. Try to overcome also your limited, yeah, the beliefs basically.
Self-limiting beliefs. Yeah.
Yeah. Then okay, I guess let's jump to your first deal in multifamily. Like, what's the source of this deal? Is it
Okay, so as I said earlier, I have invested in over 50 deals, 50 over time,
nice,
as a
nice.
passive investor. Some of them were through joint ventures, some of them through crowdfunding platforms, some of them were through active syndicators. But let's talk about the first deal as a co-sponsor. This has occurred, believe it or not, during the pandemic. We started and launched the company, Wealthy Mind Investments, sometime last year, actually close to a year and a half now. And we were selectively looking for partnership with many syndicators. But as you know, uh, it takes time to build relationships and become partners with other people, right? This relationship does not happen overnight. So we were very selective. We turned out many deals where we didn't feel we were on the same page, where the numbers didn't make sense, and not until the COVID started where we finally found a good sponsor, a good partner, and a good deal. And this was around January, February, I think March timeframe, around February, March timeframe when the COVID just started, where we were offered an opportunity to partner up with another group based in Carolina market, which we really like. And we were recommended by that sponsor. We met the sponsor for several months. We got to know them. We liked the deal. We liked the fundamentals, but we were scared. I mean, if you remember those times when the COVID was just starting to ramp up, some people thought that this could be it. This could be the end of the world.
Yeah.
We don't know how long this would last, what the impact were. And in fact, believe it or not, we liked the deal, but we didn't feel comfortable doing the deal. So we walked away initially.
Mm-hmm.
But 2-3 weeks later, we started to look at it again. And we saw the collections. The collections remained very strong at 95 plus occupancy. The sponsor shared more details about the deal, which is 300 plus units, A minus class property in Carolina, which is a very stable, good location, good schools. And then when we looked at demographics specifically to who are the people that are living in that complex, right? And this is in the Charlotte market, maybe about 20 minutes from downtown, in a very nice area. And we were pretty impressed. And then I do have a business partner. He's my friend. And we've known each other for 20 plus years. He's also local in Silicon Valley, another tech guy. We're both very data-driven, very analytical people. And then we ask ourselves, what if we, do decide to move forward with this deal and just give an opportunity to our investors to invest? And at that time, by the way, the stock market was crashing. There was a big drop of about 30% or so. And then we ask ourselves, okay, would you invest? We ask ourselves, would I invest my personal funds? And by the way, we do invest in each deal that we co-sponsor, because we believe, I think it's very important to put a skin in the game yourself, right? If you're not comfortable personally investing the funds into the deal, you should not be soliciting or offering such opportunity to your investors. So anyway, the long story short, we decided to pull the trigger and actually agreed to co-sponsor and help with investor relationships and asset management, as well as capital raise. And believe it or not, we held this webinar, investor webinar. We invited our partners as well. And we opened that opportunity up to a selected group of people that we've been in touch for a very, very long time, because we were telling them, hey, we are actively looking. Just hang tight. There will be an opportunity for you to invest with us. We know you'd like to diversify the stock market, create some tax-efficient cash flow, and participate in private placements with us, right? And we were able to raise a significant dollar amount in a very short period of time, even during the pandemic. We had overwhelming response. A lot of people jumped an opportunity to invest with us. It was a cash flowing asset from day one, very conservative. Break-even occupancy was in the 50s, with the current occupancy that is paying at 95, 96. And as you know, the cap rates have shrunk, so there is very little difference between A, B, and C, and this was A minus class.
Oh, yeah.
And we just look at it, very conservative asset. It was a 10-year fixed term, under 3%, 2.75 if I remember correctly. It was a seven-year IO. And we said, you know what, let's go for it. Let's give it a go. And we're glad that we did, because it's performing well. It's paying monthly distributions. Since then, we kind of never looked back. We've, again, co-syndicated, co-sponsored 5 other deals. And from that deal, some of the investors are actually repeat investors with us in other deals in Phoenix and in Texas markets. So that was it. I mean, it just took a lot of time, a lot of effort to build these relationships with the partners, and I'm glad we did.
Yeah. And also that one will be also a tough collect during the pandemic, which is
Very true. I mean,
yeah.
if you remember, those were scary times, and before the pandemic was just taken over, the deal flow pretty much disappeared over the last 3-4 months, right? So this was negotiated before COVID. Then we actually got some additional discount of $1.5 million because of COVID, right? So they were able to reduce the price even more because of COVID-19. We just felt good about the asset after we re-looked at it again. Very high occupancy and paying 96%, low break-even, amazing terms. The sponsor team is local to the market. They know the area. This is the second asset they're buying from the existing seller that they had the relationship. This was also off-market deal, and they have 7 other assets nearby in Carolinas. So we just felt pretty confident moving forward.
The sponsor, yeah, nice. But so you mentioned about it's the area. Is it in Charlotte directly, or is
yes, it's about 20 minutes away from Charlotte. Correct. We really like Carolina market in general.
Okay, so it's 20 minutes from Charlotte. Then I think you mentioned about the number of units. How many?
316.
316. Okay. Then this one is class B.
A minus.
A minus. Okay. Yep. Then I think you mentioned already the. Yeah. Do you know what's the story of the property, or like any reason for selling?
The previous seller decided to move on and do 1031 exchange.
Okay,
so that was the reason for the sale.
Okay.
They were able to hold it, I believe, for 5 or 6 years. They did leave some bonds for another syndicator to work on. They did some remodeling, but this was not an old asset. It was about 9 years old asset.
Oh, okay. Yeah, I think that's really a good one. And I think that's also important, for people doing or purchasing, because sometimes you need also to think on the sell side as well. Let's say
exactly.
if you're planning for a 5 or 7 year sell, you need to leave some meat on the bone so that you have more kind of a buyer pool.
Correct.
Yeah.
So that's the strategy that we like. So the business plan calls for rehabbing some of the assets, obviously adding more value, as well as adding internet service. I'm not sure if any listeners are familiar to, because I was not. There are certain pockets in the United States where GigaFi, a dedicated internet service, is very popular and very economical and affordable. So the plan calls for installing this internet provider service and adding the revenue to it. So it will generate 40 to potentially 80,000 extra income per year.
So you will install that provider there. Nice.
Correct.
Nice. Yeah. So regarding this property, like when you're reviewing, I assume you reviewed the T12 and rent roll. Was there kind of anything that stands out that was
Well,
questionable?
we do internal due diligence, including underwriting. We actually did work at the bank back in the day, even during
Okay.
subprime. So I have a mortgage background as well. So I'm very familiar with financials. But not only that, we actually do more due diligence than that. We have some friends in the business that we share some additional resources. So we did run a co-star report. We looked at rental comps in the area as well as some of the new development around it. We also looked at the financial business model, the break-even occupancies, the worst-case scenario, as well as ask somebody else who has also underwriting background to kind of double check and validate our numbers. And all the numbers look good. I mean, that's the reason why we decided to pull the trigger and actually do proceed with the deal, even though at first we were a little bit hesitant because of so much unknown, right? There was just a lot of unknown because of COVID-19. But at the end of the day, again, the timing was right. We were looking for a cash yield play that would pay out 5 to 7% cash flow from day one. And the payouts have been monthly, right? So that's what attracted a lot of people, especially during the stock market crash that did occur because of COVID, right? So a lot of people started to panic. They decided to redeposit, reallocate their portfolio, and some people did feel like this was a good cash yield play, much safer, a lot less volatile investment vehicle versus stock market, right? And the savings account, as you know, they pay absolutely nothing, under 1%. So this was a cash flow yield play with an upside of the appreciation of 15 to 20% annual upside returns.
Oh, nice. Yeah, then for this particular deal, like what was the original asking price of the seller?
I believe it was over 50, 51 or 52, but like I said, we were able to negotiate a $1.5 million discount because of COVID.
Okay, so you were able to get it around less than
49 and a half, I think,
49.
under 50 million.
Under 50. Okay, wow, that's big. Yep. Then was there what's the economic vacancy of the property when you bought it?
96%.
96%. Okay, nice. Then if you can repeat the financing breakdown. I know you mentioned about like it's a 2.75 interest and 7 years IO.
Correct.
Right? Then
10-year fixed, 7-year IO.
Okay, so it's a 10-year fix. Okay. Then amortize over 30
years.
Yeah. Then so how much was the loan amount on this one out of the 49.5?
I don't remember the exact numbers.
Okay, that's fine. Then this property, right? Like what's the investor split on this, if you recall?
70-30.
70-30 flat. Okay.
So GP would get 30%, and then LPs would get 70%. There is a waterfall structure. I believe it was 70-30 until 14 or 15% IRR, and then it's a 50-50 split thereafter.
Okay.
Including the 7% pref.
Okay. Oh, so there's a 7% pref. Okay.
Correct. So first 7% LPs get.
Okay.
As limited partners.
Yep. I guess like for the listeners, a waterfall means is like once kind of a milestone is hit, let's say that 14 to 15%, then the split changes to that 50-50. So
correct.
That means of the waterfall. Then what's the business plan for this deal?
It's a light value add. So we're gonna again add some washer dryers, repaint, do some light remodeling in the kitchen area, maybe repaint there as well, change some countertops, but $5,000 to $7,000 per unit.
Mm-hmm.
That was the budget for allocated to change. I think it's close to 70%, I believe. So again, we want to leave some skin for the bones for the other operator, right? So we don't want to renovate all the units.
Yeah, yep, makes sense. Then are you planning to hold it like 5 to 7 years or?
Projected hold is 5 to 7, but if we can quickly execute on a business plan, so far it's been going well. Collections have remained over 95%. Some people are moving out, so we're starting to renovate some units already, but so far it's been performing really well. Monthly distributions have not been stopped, they have been consistently paid out.
Okay. Then the goal of this is like sell it, right? Not like refinance, then keep.
No,
No.
it's such a low interest rate, and there's a prepayment penalty, so it does not make sense to refi.
Okay. That sounds good. Then what's the IRR and the average cash on this one?
15 to 18% annual returns, and then average cash on cash was 7.9.
7.9. Okay. Then this is a syndication deal. Okay, so we'll go to the next section of the show, which is the due diligence portion. Where did you do like a due diligence with the team here or the ones
Yeah,
your
so
part?
they shared all the financials, and then we did our due diligence
Okay.
ourselves. We looked at the numbers, we ran through the financial models, and then, as I said earlier, we have another person that does that as a kind of a second opinion, and then we always order CoStar report.
Okay.
We look
Then
at the comps.
okay. Yeah, that's good. Yeah. I think and also the lease audit. Then do
Correct,
you do,
demographics, rent
yeah,
rolls.
yeah. Then do you know like what kind of due diligence was done? Let's say how did the due diligence happen physically? Like someone went
Everybody, not everybody, but one of the partners had to physically go to each unit.
uh,
Until that was done, we didn't sign the contract and finalized it.
okay. So at least someone basically like your someone boots on the ground.
Yeah, one of the general partners had to physically go into each unit, all 300 units.
Ah, nice. Did you bring or did that person bring probably like a property manager with them or at least the prospect?
Yes,
Okay,
yes.
to help
Yeah.
out. Then
But
and also
we have been utilizing the same property manager on other properties.
oh
There's 7 other properties nearby within a 30-40 minutes radius. So the same property management is taking over,
this
took
one.
over the unit as well.
Oh, that's nice. Yeah. If it's a really tested property, yeah, that will be a good.
Correct.
Then yeah. Was there anything like a red flag that was raised during the physical due diligence, like something that was
No, nothing was
nothing, everything's good.
seriously uncovered. Everything was as
Okay.
planned, and there was no hiccups. It was difficult to get financing at that time. Again, there was a delay in financing in a couple of weeks or so,
Mm-hmm.
but that was the major concern. Because at that time we had to raise a little bit more capital. If you remember,
Yeah.
during pandemic, the banks started to require not only 6 but 12 months reserves.
Oh yeah, that will hit the yeah.
So we had to get a little bit more capital to preserve the reserves and to meet the deadlines and the requirement guidelines from Franny.
Mm-hmm. Yeah, then this reserve will be like is it in your bank account or is it on the bank? I mean that a certain bank account that has
Yes,
funny.
yes, it is.
Okay. Yep. Then I guess like for the capital raise, how much capital was raised for this deal?
Over 20 million.
20 over 20. Okay. Then do you know like what's the average investment by the investors?
On our part, it was 75K average.
70. Okay, average. Then oh yeah, by the way, like how many GPs were there? Like at least doing the racing.
I think there was about 5 or 6.
5, 6. Yep. Because I know, yeah, this is like a big property, a 20 million raise.
Correct.
Then, do you know like how many days or weeks did the whole capital raise?
I think it was close to 2.5 months.
Okay, 2.5 months. Then, yeah. So regarding the closing, like around how much was I'm not sure if you know you remember that the closing cost roughly on this.
No, I don't remember.
Yeah. Then how long did it take, like from LOI to closing on this?
4 months,
4 months.
4.5 months.
Nice. Okay. Then I guess, yeah, we reach on the final section of our show. Basically, this is like the final five sizzling questions. So question number one is, any lessons learned that you want to share from deal analysis, due diligence, capital raise financing experience?
Yeah, I think the most important thing is, I can reemphasize this enough, is having the right mindset, right? You have to believe in what you're doing is actually worth doing it, right? So the biggest lesson for me, for us, was at first we kind of walked away from it, then we came back. You have to be also flexible in real estate. You have to pivot sometimes in different directions and be decisive. Yes, it didn't work at that time, and then 1 week, 2 weeks later, we said, you know what, now it's working. We just had to take time to analyze and convince ourselves, right? Once we were sold on a deal ourselves that we personally like to invest in it, then it was a piece of cake. The capital raise went very smooth because we've been priming our investors for many weeks and months. We've been telling them, we've been emailing them, we've been communicating with them, we hosted in-person event, and we were very transparent that we said we're not going to sacrifice just because we want to do our first deal as co-sponsor. We would like to find a very conservative, good deal that we liked, that we will recommend to you. And it happened. I mean, having that clarity and conviction and confidence, even though sometimes it takes a little bit longer than you think, because there is a little bit of eagerness, right? You want to get the monkey off your back and just do the first deal as soon as possible, right? But you'll know, you just need to feel, kind of trust your gut feeling, sort of trust your instinct when you know it's the right deal. And then just go full in. Put all the hard effort and your soul into it. Make it happen.
Yeah. Yep. Yeah, I think I like that the one that you mentioned, like, yeah, it's really important that you don't push it that, oh yeah, I want to get the first deal, but sacrificing the return, I mean the risk, basically.
Yeah. I can't tell you how many people I see, they're eager, a little bit desperate to do their first deal, so they align themselves with maybe inexperienced operators, with people that are just testing it, trying things out. We were never comfortable doing such thing and being in that model, right? We took time, we analyzed many markets, we turned down many deals. We were offered many deals to participate, and we just said no. I mean, it's okay to say no.
Yep. Yeah, I think also like for our listeners too, like the ones who wanted to get their first deal, it takes time and it takes a lot of underwriting, maybe hundreds of underwriting before you can even find one.
Correct.
And don't rush it, because if once you mess up your first deal, then it will be hard to it will take time for you to
exactly
recover.
You don't want to have such a situation where it's your first deal, because it's your reputation on your line and your investors are trusting you. They're putting a high trust in you, right? So since then, like I said, we've had repeat customers on several deals because we took time to analyze the deal that's been performing well. It's kind of a snowball effect once you get rolling, right? So do take time, trust your gut feeling, get educated, and then just go with your full heart in.
Yes. Yep. Okay. Then yeah, that's the second question is like, any recommended books?
Best ever syndication book by Joe Fairless, the apartment syndication book. If you have a chance, or if you have not have bought that book, I would strongly recommend that.
Yep. Yep. Yeah, I think it's in Amazon. Then yeah, and
Correct.
also I think they have also this apartment syndication, best ever apartment syndication school.
It's on my bookshelf somewhere. I was gonna show it to you, but oh, here it is. Yeah, this is the book. I'm not sure if people
Yeah,
can
choose
see.
it.
Okay, well, I have a bad screen. Okay,
Yeah.
people cannot see it because I have a virtual screen. But it's
Yeah.
called Best Ever Apartment Syndication Book by Joe Fairless.
Okay. Yeah. Thanks. Then any recommended podcast or YouTube channel that you're listening to and would recommend?
Well, you can listen to our YouTube channel. We
Yes.
host a lot of webinars, a lot of education. So just type wealthymindinvestments.com for our YouTube channel. We do invite speakers as well. We hosted webinars with other busy professionals, with tech people, with real estate people, with passive investors, with CPA, with retirement custodians. I also like to listen to Lightbridge Capital podcast with Whitney Sewell.
Oh yeah.
I think he provides a lot of good insights as well.
Okay. Yeah, sounds good. Then yeah, so number 4, this is the time to promote yourself. What's your acquisition criteria for multifamily and like location, number of units, class A, B, or C?
Yeah. So number one asset class for us would be light value add multifamily over 100 units. We look for cash flow and yield play, right? So if the asset does not cash flow from day one, we're not doing this deal. As far as asset class type, we're kind of flexible. I think over time, everybody was looking for B minus, C plus. Now there's such a variety of different assets that you can get the same yield play even for A class, right? So we're sort of flexible when it comes to asset class. We look for A, B, and even C plus in this market. Some people will say, it is better and safer, less volatile now to look for A and B, but it just depends. As you know, real estate and sub-markets are behaving very different in each unique place. For example, right now we're looking and raising capital for a deal in Phoenix, and it's a C plus asset.
Yeah, yeah. I think that's important to that don't tie you up. I mean, don't tie up in that ABC. I think
Yeah,
the
be
important is the
flexible.
right thing. Yeah.
Do have your set criteria that you're looking for, but also be flexible a little bit as well.
Yep. Yeah, it's all about the numbers, and by the end of the day, the
Correct.
cash flow, the cash on cash that you will be getting monthly, or yeah.
Correct.
Yes. Okay. Then what's the number? The last question is, what's the best way to contact you?
Yeah, so you can contact me via my website at wealthymindinvestments.com, or you can email me at alex@wealthymindinvestments.com, and I'm pretty approachable. I'm not one of those gurus that don't pick up the phone, so you can actually call me or text me directly. My number is 415-608-2115. Happy to connect with anybody and get you started passively or maybe actively investing. Maybe one day we become friends and partner on a deal together.
Yep, that would be awesome for anyone who's like looking like actively in for deals. Then yeah, and also like I will also put in the show notes all Alex contact information so that you can reach out to Alex anytime. Okay, I think we reached the end of our show. Thank you again, Alex, for your time, for accommodating the show, and then hope to talk to you more on the future deals.
Excellent. Thank you so much for having me, Jeff. I appreciate it. Please feel free to reach out. I'm very approachable. I believe in a right mindset, in a law of attraction and abundance. Real estate, as we all know, is a team game. You cannot survive nor win in this game by yourself. You need to have mentors, business partners and other people that are helping you along the way.
Correct. Yeah, yeah. And I think for our listeners, network. I think that's the important thing is network with people so you tend to know more about the different persons and see like who you like, which has same core values as you. Yep.
Exactly.
Okay. Thank you. And
Thanks for having me.